Welcome to Macro Hive Conversations with Bilal Hafeez. We aim to bring you the best macro analysis to help you successfully invest in financial markets. For our latest analysis, visit macrohive.com.
Okay, so we talk a little markets?
Yeah, let's do that. Yeah.
Okay, perfect. I don't want to say the last kind of 6 to 8 months that if there's any kind of thing I feel like investors particularly think about when they think of Macro Hive and even you, is probably your views around inflation and interest rates. Do you want to give everyone an update of where your thinking is and maybe even slight progression over the last couple of months?
Yeah, sure, absolutely. Yeah. So obviously this year there's been a huge amount of focus on inflation, and there's been scaremongering around how high inflation has got and so on. But my view is that fundamentally we're still in a low inflation regime. And when I say regime, I kind of, I'm particular there because you can always have some volatility within a regime. So, you can have spikes of high inflation for 1 or 2 years, followed by periods of low. But fundamentally, you need to know, are we in a prolonged period of widespread inflation like we had in the 1970s, where it was everywhere, like every single sector of the economy had rampant price increases. Inflation was running 5, 10, 15% year after year after year, and it's widespread across the world as well. So for me, that's an inflation regime. A low inflation regime is one where inflation generally gravitates at very low levels, between 0 to 2%, say, and you have volatility around that. So fundamentally, my view is that we're in this low inflation regime. And in a moment, I'll go in to talk about why I think that. But what that means is that when you look at interest rate markets, which are in some ways an aggregation of what's the long-term expectation of inflation, 10-year bond is 10 years out. If you fundamentally believe that we're still in this low inflation regime, that means that interest rates are going to remain low. So one of the strongest views I've had this year is that whatever the moves in inflation, because structurally we're still in this low inflation environment, interest rates will be low. And this has been one of the big kind of paradoxes for people this year, which is that, okay, inflation's so high, but interest rates are low. So, why this discrepancy? And so from a trading perspective, this has allowed me over the last, say, 6 months to kind of pivot from being short rates at the start of the year, because I had this view that we were in a reflation environment, to a view later and from April, May onwards to say, actually, now you want to go for flatteners, lower interest rates, because we're actually not in this high inflation environment. The market got too caught up in that. So that's kind of
obviously been
which has worked out really well.
Worked out well, and people are always asking, what are your non-consensus views? I would say you've been pretty non-consensus. This is from this spring, I think, when people were calling for a 10-year at 2.5%, higher.
And the reason I have this view on inflation is, like, number one, I'm going back to the historical point. If you look at inflation over the last 1,000 years, the Bank of England has some data on this. Obviously, it won't be so precise, but over the last 1,000 years in the UK, inflation has averaged around 1%. So over the very long run, inflation tends to be very low. But what you find is that it's punctuated with periodic bouts of very high inflation, which usually occurs around wars, when governments issue debt, print money to fund the war effort, and capacity is destroyed during the war, and then you have this rampant inflation. And so that's normally the periods we have a high inflation. Right. But the tendency, though, is for inflation to be very, very low. So that's my kind of base case, that generally inflation should generally gravitate towards like 0. And if anything, if you look historically, you have periods of very high inflation and you have periods of deflation. So if anything, over the last 30, 40 years, we had this very high inflation in the 70s, and we've been falling since then, but we haven't really had any periods of deflation. So if anything, the risk in the next 10, 15 years is that we have bouts of deflation, which is what you see on 1,000 years basis. That's kind of the risk. So that's kind of one observation I would make. The second one would be a lot of people
mainly driven by technology, or just
I mean, so I think the reason why you'll see lower inflation is a few reasons. One is, if you look at the inflation we're seeing today, it's very narrowly focused. So for example, this year on average, US inflation has averaged this year around 4.5%. But if you look at core inflation this year, it's been closer to around like 3.7% or so. But if you look at core goods, or if you look at the energy components, that's gone up 20% this year. Core goods, which includes the famous used cars, has gone up 6% this year. On average, in the last 20, 30 years, core goods has gone up about 1% a year. So this year, you've had a multiple standard deviation move up in the price of core goods. Yet core services, which make up a larger component, this year is averaging around 2.5%. Over the last 30 years, it's averaged around 3%. So this year, we've actually had lower than normal kind of inflation. So what all of this tells you is that in reality, this year, what we've seen rampant inflation in energy and rampant inflation in certain components of the goods sector. But then if you step back and look around the world, if you look at the US, as I said, this year, headline inflation has averaged around 4.5% this year in the US. China, the second largest economy in the world, how much has inflation been? 1% this year. Euro area, third largest economic bloc in the world, 2.5% inflation. Japan, fourth largest economic region, minus 0.2%. So this idea that we're in this like super inflationary environment just isn't verified in the data. If we are in this environment of
world, the markets or the media is so focused on a US centric view, or it's just like that's the stuff that
I think
that and the Fed.
I think there is this bias in the media and the financial media to focus hugely on the US. The US isn't everything, but also it's a good story to tell. Inflation sells. Policymakers, like pundits, high inflation sells. You're going to get headlines. We find that with Macro Hive, when we publish a piece on inflation, we get a higher hit rate than ones when we don't have it on inflation. So that's another thing about this all. But the reason I mentioned this cross-currency comparison is that lots of people are saying, oh, because of deglobalization or because of supply chain and all of these sorts of things, we're having this rampant inflation. If that's the case, and if it's structural, you should see that everywhere in the world, and you're not really seeing it at the same scale as you'll kind of think. But more than that, I think that the reason the US has had higher inflation than other parts is that the nature of the US fiscal response has been very different to other countries, where the US essentially gave checks to people, the US fiscal response, which made people's income go up during a recession, which in other countries didn't happen. And people had checks and they weren't able to spend it on going to a restaurant or going on holiday. So they ended up buying goods, which ended up leading to this global supply demand imbalance of, goods prices going up around the world because of, how strong the US is. Other countries didn't do that. Other countries did what's called furlough schemes, where the governments were paying companies to keep people in employment, which meant that their income stayed the same. And so you didn't have the same consumption boom. And so as these effects roll off in the US, then you'll start to see that those pressures start to roll off too.
I guess let's just quickly touch on it, is COVID and general views on global growth.
Sure. Obviously, COVID, is still with us, which is quite sad in many ways. And we have the Omicron, variant, which we're still in the midst of understanding. But for me, the two important things about COVID are, number one, what markets care about is how governments respond to the virus. So obviously the virus is terrible from a health perspective, that's a given. But what we're talking about here in this conversation is about what is the market impact. And the market impact is related to government restrictions. And so you could have a rampant pandemic, but if the government doesn't make any restrictions, then the economy and markets may just actually do fine. And that's actually what we've been seeing, that each successive wave we've been getting of different COVID variants, the government response has been less aggressive. There's been less lockdowns and so on. So that's one general observation, that what matters now with the Omicron variant is how are governments going to react to it? Will it lead to some aggressive lockdowns or not? Now, with the Delta variant, governments, especially in the US and say the UK, to some extent Europe as well, basically said, actually, we don't need to do a lockdown, which allowed the economy kind of to rebound nicely. Now, with Omicron, there's kind of two features of it that could lead to more aggressive lockdown measures. Number one, that it in terms of being infected, vaccines appear not to work so well with Omicron. So we're going to have a lot more cases right now of people who've been double vaxxed who get infected with Omicron, which wasn't the case with Delta. So that's going to cause a problem for governments. Like, how do you respond to that? Because you've been saying vaccines are the savior, yet I'm getting infected with Omicron. Then the other part, which is a bit blurry right now, is young children. It seems like Omicron is affecting young children, like children under the age of, say, 9, more than Delta or Alpha and Beta, the original variants. And so there's a potential there. If you suddenly start to see hospitalization of young children, that could cause a government response. So that's a key thing I'd be focusing on with COVID. So understanding how are governments going to respond to it and how aggressive will they be? The other part of government response is, okay, even if they don't respond, people may respond themselves. People may get scared and adapt their behavior. We saw that with Sweden, where they basically didn't have a very aggressive government restrictions, but people just changed their behavior. And so that could be an effect that we could see with COVID.
Quick question. So has Omicron or the risks and the different kind of possible paths that this could take, is this changing your general framework and thinking about markets, or it's more in the monitoring stage right now?
I would say that it has changed my view in the sense that I think this provides some downside risk to growth. It did seem like we were in a nice bounce in growth going into Q4 of this year and early next year, but this suddenly dampens a lot of that. So this, in general, I've been positioned quite defensively for the last 4 or 5 months. And I was thinking of winding down some of those defensive trades on US markets, but now I'm going to keep those defensive positions on, because I think Omicron is something that adds some downside risk. Another part of that, I think, also is that the Fed's become a lot more hawkish as well, which doesn't help either.
Yeah, because I guess traditionally people viewed slowing in growth. Is it bad for risk or good for risk? Often it would mean, that's maybe good for risk because that would keep very accommodative policies in place, or even more accommodative from the Fed. And that seems like maybe that link has been broken. And do you believe that has been broken and will continue to be broken?
Yeah, I mean, I think to a large extent it could be broken. I mean, the one kind of issue with all of this is it depends which risk markets we're talking about. Right. Some risk markets will be very sensitive to short-term interest rates if the Fed's very hawkish. So for me, that would be more the sort of small caps, for example, and some of the riskier ends of the market will be more sensitive. Whereas like tech companies, some of these larger companies that are more sensitive to long-term interest rates, they'll actually do okay, because if we're in an environment of weakening growth, but an aggressive Fed, long-term interest rates will stay low or lower than you would have expected as the curve flattens, and that ends up helping these large cap companies that are cash rich, that will benefit from flows into them as interest rates fall.
Maybe even kind of continues to accelerate a move towards technological solutions.
I mean, we didn't sort of talk as much about this before with inflation, but I think for me, I think a lot of people, when they think about the consequences of COVID, they're looking at the wrong thing. They're basically focusing on supply chain disruptions and how onshoring, that will be the big outcome.
Right.
For me, that's almost trivial. I mean, maybe some of that will happen, but that's not the big story. The big story is the digitalization of the world. What COVID has done is it's accelerated technological adoption. It's forced people to work in the digital world a lot more than they would otherwise have, whether it's through Zoom calls, through having to use Teams or Slack or whatever to interface with other people. It's forced people into this world and using the cloud a lot more than before. And not only that, but what COVID has done is that it basically shut down essentially the service part of the economy, either the parts of the economy which requires humans to be involved. And so suddenly companies have had to say, okay, how can we offer a service to people, without workers? The answer is technology. So the manufacturing sector over the years has been massively disrupted by technology. So, to run a factory, you need much less people today than you did in the 70s because of robots and so on. Yep. The service sector is still quite labor intensive, so whether it's restaurants or supermarkets or, musical concerts or whatever, requires lots of people. Yeah. Doctors, all of these. Now, suddenly with COVID, companies are now saying, okay, without people, how can we offer these services? And you're seeing all sorts of clever ways of doing this. So in supermarkets, this trend was happening anyway, but there's self-checkout tills, less people involved. With restaurants, what you're seeing is delivery services are becoming more popular. And what's interesting about delivery services are that traditionally restaurants would occupy the most expensive real estate. They'd be in high streets, so you'd have a restaurant and a kitchen there. Now what's happening with delivery services are saying, okay, we'll have the brand name of the restaurant, but the kitchen will be in a cheap industrial estate in what's called a dark kitchen, like a warehouse. We'll cook everything there in a central location rather than having like 20 kitchens in 20 different parts of the city. And then we'll have an army of little mopeds going around delivering the food to people. And that's much cheaper for a restaurant to offer that service than to have the real estate in an expensive part, to have, all of that. So suddenly the restaurant business is being disrupted in that way. And all of these things are just adding, on top of each other. And that in the end means that this for me is disinflationary, profoundly disinflation for the service sector. And I think this is something that's not really being appreciated. And another part of this is how it's flattening the labor market, in the sense that if a company is remote, it doesn't need to only employ people who live in the same area as the company operates. We find at Macro Hive as well, when we first started before the lockdown, our bias was to hire people in London and New York. After the lockdown, we suddenly said, actually, we're all remote, so let's just see where we can hire people. So we have a super smart, machine learning person who lives in the Midlands in the UK, web developer in Berlin, great economist in California rather than New York. It just opens up the market. And again, that's something that's disinflationary in the long run.
Definitely, yeah. By the way, of a lot of your core ideas around like your general framework, for me, I always find this one the most interesting, because I really think the idea that technology advances have probably, I think I've heard you say in the past, have been condensed from maybe even 5 years into 1 year.
Yeah.
Like there is absolutely long-term impact from that.
Yeah.
And people are so have such like kind of a myopic view when they listen to things on Twitter and I paid 20 cents more for milk, which absolutely for a lot of people is an issue. But the general approach towards inflation, and especially if we're trying to think about things, but often hard to do, but trying to think about things, especially around people's investments over a 5 and 10 year horizon. These are core things, at least my impression, that this is a core thing that people should be thinking about. Okay, so maybe we'll quickly touch on, and I think you did a little bit around China, and obviously you have some pretty unique experience from, as you said, with interaction with PBOC. What's your general view on China? And then we're going to go to everyone's favorite topic, crypto, right after.
Okay, yeah, on China, my kind of sense on China is like, just based on my experience of interacting or of spending a lot of time in China, interacting with policymakers there, is that China in some ways is the same as any other country. I mean, we've got this habit in the West of thinking China is this special, country that can, build super fast train tracks in like 2 days, and they can do things much better than everybody else? The answer is no. They're just like any other country, So all the challenges other countries have, they have.
I've definitely never heard. Okay.
There's, they have rampant corruption in lots of parts of the economy. They have developed some parts of the economy, but if you look outside the east coast of China, like further inland, there's massive levels of poverty. So if they were so good at developing everything, the whole country would be developed, and it's not.
Right.
So just like we have challenges in the West, where you look at, like in the UK, London looks great, but then economically, but north of England doesn't look so good, or in the US, like South Dakota doesn't look as isn't as wealthy as California. China has those problems as well. So that's one sort of general kind of thing I would say. The second thing I would say is that COVID has provided an opportunity for China to finally deleverage the economy in a way that they've been trying to do for the past 10 years. So in some ways, kind of the story of China in the recent period has been that they did this massive fiscal stimulus after 2008, which allowed China to grow while the rest of the world was contracting. But that led to massive overcapacity and all sorts of leverage problems. And ever since, say, 2009, 2010, they've been trying to get rid of the excesses they built. It culminated in 2015, where the economy essentially went into recession. They panicked and re-stimulated the economy. And they devalued the currency that year as well. And they've had this stop-start approach ever since. They kind of see some froth in some part of China, and then they try to slow, the economy slows too much, then they give up, they stimulate. But I think COVID is a structural break in the sense that it's allowed them to more seriously engage in these reforms. Now, why is that? Number one, because the economy collapsed so much, the growth in China and everywhere else, once the economy reopens, you'll have this big bounce. So even if you slow the economy down from reforms, the bounce is so strong, it will cover any of the losses you get on one side. The other benefit you get with the lockdown is that your society is much more willing to take orders from the government during COVID, because of the lockdown. There's more, you have a higher ability to control the population. The borders shut down as well. Right. So in that way, you could control dissent a lot more, or you can use COVID as a cover for other reforms that are going on. So that's, you're seeing some of that in Western economies as well. So that's another reason.
What about all the extra liquidity that Japan and Europe and the US have put into the global economy? I'm sure that's benefited China.
Yeah, absolutely. Yeah. And if you look at the structure of Chinese growth over the last year and a half since COVID, what you find is that domestic demand, like internal demand within China, has been really weak. So if you look at retail sales, just all the internal metrics have been weak, property even. But their external numbers have been great. Exports have been off the charts. China's been essentially producing all the stuff from around COVID and exporting it to the rest of the world. COVID equipment, I should say, not the virus. That's another conversation. And so they benefited from the rest of the world bouncing, and that allows them to kind of have this cover. The other thing that has become apparent during COVID is the power of tech companies in China. Just like we've seen in the West, during the COVID period, we've had to use tech companies a lot more. China had to as well. And that made it clear to Chinese authorities the power of tech companies. And China is in the process of centralizing power around President Xi. And so any alternative power blocks have to be curtailed. So all of this is kind of providing the perfect backdrop for an aggressive reform program. And one of the key things I think on the leverage side is that China did do some credit easing during the lockdown, during the COVID period, but it didn't lead to as much growth as it historically would have. So just to give some numbers to this, before the global financial crisis in 2008, for every dollar the Chinese provided in credit, you'd get $1 of growth back. Today, after COVID, for every to generate $1 of Chinese growth, you need $12 of credit now, because the amount of leverage in the system is so much that essentially so much extra borrowing just goes into servicing bad debts that are already on the balance sheet. It doesn't go into doing anything new.
Right.
And so they recognize this. So they have to delever the economy, which has to be focused on the real estate sector, which is the biggest source of leverage in the economy.
So just real quick, what's the best way to play that, or what, like how would an investor think about protecting their portfolio and influencing their portfolio?
I would say there's a couple of ways of playing a China slowdown. So my kind of core view is that China is in the midst of slowdown. There'll be some, bounces here and there, but fundamentally China is going to be slowing, next year, the year after, and so on. So you want to play China slowdown in some form or another.
And when you say slowing, like 4% over the next couple of years?
Yeah, I mean, I think we could easily get to 4, maybe 3% or so, those sorts of levels. Now, the official numbers are one thing, but we built our own proprietary models which track the Chinese cycle, and that gives you a sort of a more true estimate of growth then, and it will be lower than what people are forecasting. Now, in terms of how to play China, we've crunched the numbers, and essentially from an equity perspective, it turns out that Chinese equities are not a good way of playing a China slowdown. Now, one reason for that is often when China slows down, they do some credit easing. They inject liquidity into the economy, and that liquidity ends up in equities. Another reason is that often when Chinese stocks fall sharply, mysterious buyers of Chinese equities suddenly turn up. The authorities have ways of propping up Chinese shares. So it's less of a pure play. Instead, other Asian stocks are better play on Chinese growth cycle. Like Korea especially is very tied. Korean stocks are very tied to the Chinese cycle because there's a sort of trade tech sort of exchange between the two countries. There's tourism flows between the two as well. So equities, that's the trade. The other trade is rates. What you should expect for China over time is that Chinese interest rates, long-term interest rates, should fall over time. Already, Chinese real interest rates are actually very high. Other countries around the world have negative real rates, but China actually has positive real rates. So real rates should fall, and nominal rates in general should fall. So being long Chinese bonds, so looking for Chinese yields to go down, is another way of playing it. And perhaps the quirkiest one is the currency, where in general, my sense is that the Chinese renminbi acts more almost like a counter-cyclical currency, like the Japanese yen now. So when China slows, I actually think the Chinese yuan will strengthen. And that's one of the things we've seen this year. People have been surprised about the currency strength, and that's been one of our biggest views. And I think that's part, of this overall story.
Yeah, that definitely has been a contrarian view all year, because all year, a lot of people have been concerned about a slowdown in China. But I guess what the impact and how that will impact markets, people have had different views. And I know for years, people have been looking to bet on a 15% blow up in the Chinese currency. And even this year, I feel like clients have been asking that question, and you've been pretty consistent in thinking, and I've clearly been right so far, that A, the currency could even strengthen slightly, but B, in a deleveraging period, the most important thing, and when you said it makes a lot of sense, is lower vol, and just project stability as a core thing.
Absolutely, yeah.